In the game of loans, you either win or you learn. Welcome to the game of loans, where fortunes are forged and empires are built. Your hosts, lords of lending and wholesaling, are here to guide you through the realm of real estate and wealth building. Brace yourselves, cash flow is coming. Welcome to the Game of Loans, episode 5. So today we're going to talk about some market trends that Ross and I think are going to happen in 2025 and the end of 2024. So what are you thinking, man? A lot of people have this fear built into them, especially from the media, that doom and gloom is going to happen, and so on and so forth. I know you and I have spoken to people that are even way smarter than us. And what do you think about what they told us? Well, first, I guess tell them what they told us, and then give me your opinion on what you think about that.
Yeah, I mean, the experts in finance that we work with day in and day out, these guys know where the market's moving before any of us do. They're controlling trillions of dollars, in investments, and if anything, they're swaying where the market's going.
Right.
A lot of fear around, the elections, whether or not, we go blue or red. I think the consensus is that the Senate and the House are going to be divided, and there isn't going to be any material policy implementation, at least for the first 2 years of the next president's term. Paired with this, we're seeing inflation, moderate, and on a wholesale basis, we're already at the Fed's target of 2% or below, and on the retail side, we're continuing to trend downwards and closer to that 2% mark. Hence, the Fed coming out, last month and reducing interest rates by 0.5%. That was primarily driven off of increasing unemployment and cooling inflation. This month's report came in a little higher than expected. They're expecting, I think, a 0.1% drop in the CPI. Ended up coming out flat at 0%. We're still kind of in the mid-high twos, above where the Feds want us to be. Unemployment is continuing to, increase, which is a sign that the economy is cooling. Inflation's cooling, which should give the Federal Reserve more ammunition to continue to lower rates. Although, the market came out and they're kind of 50-50 on whether or not we're going to get a rate cut this month or skip heading into next month.
What's your feeling on it?
I think that they'll continue to cut. We'll get another 0.25 point reduction. I think if they skip a meeting, that'll instill some fear in the market, and cause some unnecessary disruption. If inflation was going up, it would be different than if it were just flat.
Right.
So I don't think they really have to jump out and do anything. There wasn't a major change in, the job data that came out. And I think we'll continue to see, reductions, over the course of the end of this year through next year that'll get us probably to a federal, fund rate of somewhere around 3.5%. We're still sitting and hovering in the right around 5% today. So give us 150 to 200 basis points of relief there. 30-year mortgages are more tied to the 10-year treasury. That's a longer outlook on the interest rate curve, so we're not going to see that big of a drop in 30-year mortgage rates. I think by the end of the next year, we might see something with a 5 handle, but I don't think we're going to get much lower than that.
I think let's talk about that, though, right? Let's talk about the 30-year mortgage not being tied to the Fed rates, right? Because I get a lot of comments when I do talk about rates dropping, and obviously a lot of people don't realize, that we're in the private money space, and when I say that the rates are going to drop, they automatically think that it's the 30-year that I'm talking about. And I get the fact that the 30-year is tied to the 10-year, right? And but the same factors go into it. Never do you have the Fed rate going down and the 30-year rate going up. It just never happens, right? So it's that would be fucking crazy. So when I talk about that, and a lot of people come back and they make these fucking comments, the third, you're talking about two different things. The Fed rate and the 30-year aren't tied, blah, blah, blah. And I do agree with that. But what they don't understand is if the Fed rate is trending downward, that means the fucking 30-year is trending downward also.
Yeah, what you can see in certain cases, play the other side of the coin, is you can see a slight uptick in the 10-year Treasury while the Feds are still forecasting coming down. And where that would occur is like over the last couple of weeks when the job data came in a little stronger than expected and the inflation data came in higher than expectation, the market changed their assumption that the Fed might not cut as aggressively.
Right.
And so that's already priced into the 10-year curve. So you saw like a 10 basis point bump in the 10-year. Well, it's already back down below that and has come below those levels. So that slight uptick in the 30-year rate, last week, has already been offset and is back in line, as people kind of readjust their assumptions of the forward interest rate curve. And that's just an outlook on where interest rates are going to be over a longer period of time. So when you're talking about, we were expecting a 1% by the end of the year reduction, and now it's maybe 3/4, and they're modeling out somewhere in between at 87.5 basis points. That's where your movement in the 10-year assumption changes, because the front end of the curve, the forecast of the interest rates over the next, 3 months might be lower than what they had last week. So small blips, but generally, when you're in a downward trend, on, the Fed fund rate, that's going to adjust, the front end of the 10-year curve, which would be like the first 12 months of your 10-year interest rate outlook. That's where you get slight movement, up and down. So on the private money side, we're lending out 12 to 18 month, money. And so in that market, you tend to see interest rates almost directly correlate to the federal fund rate.
One to one.
Because a lot of the groups that are purchasing these loans or financing these loans through financial institutions, they have a index which is generally SOFR, which is an overnight or 30-day average borrowing rate, that is pretty much in line with the Federal Reserve rate. And then there's a margin, and the margin is an amount added to that number based off the risk of the assets that you're financing. So if you're financing, short-term hard money loans that may be perceived as more riskier, they may price in a 4, 5, 6, 7% margin, depending on, what LTVs you're lending at, what type of assets, commercial, residential, construction, fix and flip. All these things factor into like what that borrowing cost is. And then you have a cost of your equity. So you gotta, if you're not putting up your own equity, in that fund or, the financing vehicle, then, depending on what the market's charging, that is, the haircut portion of it where, the bank gives you 80% at SOFR plus a margin, and your equity is the 20% haircut there. That number is like your cost of your private equity. So, in today's market, that could be as low as 6% if you're a really big company. It could be as high as 18% if if you're high risk, in a smaller group, borrowing that money.
So something you brought up. You said that a lot of people perceive the short-term loans to be more dangerous than the long-term 30-year mortgages, right?
Yeah, I
shouldn't say dangerous. They're more risky, right?
Yeah, I think the market, like people who don't understand the product, may perceive that it is a more risky investment because there's not a income component, to qualifying the person, for that loan. But the people who are actively investing in that space and are buying those loans in the market, they understand the risks. And
but what is the risk? I mean, because a lot of people that we speak to have that perception that you say. It's, well, your loans are riskier. And I try to explain to them, well, you know what? I would fucking invest in a short-term loan over a 30-year loan any day. Yeah. And I think that investing in a 30-year mortgage is a lot more dangerous than investing in a short-term 12 to 24 month deal.
So this isn't my personal perception, but if I were to, kind of sit on the other side of the table from you and make argument for the other side, There's lack of income verification for these and their ability to afford the payments, and there's execution risk in the project, and because you're lending on a property that needs renovations or improvements, and you're relying on somebody to actually execute on completing that project.
Right.
And that execution risk has a timeline component to it, and if something changes from the point which you lend the money and the point which they finish that product, you're moving toward, you're underwriting to like a future value of that product versus what it is today. But on the other side of it, bigger down payments, which make it a lot less risky in the event of default. There is an experience and like a track record qualification component to their ability to get the project done. And then, these are commercial purpose loans. So if the borrower defaults, it's much easier to get back to that asset than a consumer loan. Like, for example, in New York, it could take you 3-4 years or even longer,
Try 6-7 years.
to be able to foreclose and get the collateral. Yeah. Think of what could happen to the condition of that property over that period of time. Deferred maintenance, if there's damages inside, you can't go in there and touch that property as the lender until you own it. And so I personally think that there's a lot more risk, on that side of the coin. So if you understand the product, it's a relatively safe investment.
I agree with you. So, being a normal, 30-year lender for many years and having to have gone through the foreclosure process and dealing with people and, so being on this side of the coin, when people tell me, oh, it's fucking risky because of the same stuff you just noted, I explain to them, well, on the other side, people are putting fucking 5% down and we're counting on them having a fucking job, right, forever, which doesn't usually happen, right? In an economy that's downtrending, a lot of these motherfuckers that are on W-2 jobs, they end up losing them. Then what the fuck are we going to do, right? And then the other risk is in, like you said, the protections around a owner-occupied property as opposed to a investment property are so much greater, right? Because no one really wants to take someone's owner-occupied property away, right? And the lending laws are based around, that protection to make sure people are protected when they buy an owner-occupied property, right? Where in our business, where it's business purpose only, they kind of say, well, you know what? You took a risk on the business side and you're shit out of luck. You're not going to get the same fucking protections, right? So the foreclosure laws and all of that stuff. And then let's even, and obviously the more we lend, the higher risk of foreclosure. It just is what it is. Having foreclosures or having loans go bad is a fucking byproduct of how much business you do. Has zero, obviously, if that ratio goes super high, then it has something to do with your underwriting capabilities, right? But even if you underwrite something super well, and we've had deals that have gone bad, and we've looked back on our underwriting, and we even said we'd make the same fucking decision, right?
Yeah.
Had nothing to do. The property was fine. The borrower was fine. It's just different circumstances that make that deal go bad. But on the 30-year side, when that deal goes bad and, you have to kind of go to plan B and figure out how you're going to what are you going to do with this property, right? How are you going to manage the foreclosure? When it goes bad on that side, on the market, the losses that you take are so much greater, right? On the scratch and dent. When you go to scratch and dent to 30-year mortgage, you're fucked. If it's a 30-year owner-occupied property, what are you getting in the market? 50 cents on the dollar?
Yeah.
Right?
Depending on the state, depending on, what LTV the loan's at. Yeah, there's a number of factors,
agree.
But yeah, I mean, it's
it's not the same in our business.
Yeah.
I mean, we're, when it comes to our business, because like you said, there's more of a down payment. A lot of people are buying these homes at a discount to begin with, right? So when it comes to our business, it's different, in my opinion. But, obviously I'm biased.
Yeah, look, I mean, everybody has an appetite for a certain amount of risk, and some people are familiar with traditional owner-occupied mortgages, and you have a much bigger buyer base for it. It's easy to sell somebody like this is a FHA loan. They understand what that is.
Right.
But when you start adding the complexity of commercial purpose loans, business purpose loans, fix and flip, new construction, people start to get weary. But I mean, we're lending on average 75% LTV on the as-is value and about 58% of after repaired value. So you're telling me you'd rather have a 97% LTV loan just because someone has income to pay for it? Well, we finance the interest payments into most of the loans that we do for the course of the renovation, so there's no payment execution risk. We're verifying their track record and their experience to make sure they've done projects that are similar to complete that, and they've got significant skin in the game. So they're not going to walk away from that project if things get tough. Whereas a homeowner, they might just say, look, I can't afford it anymore, foreclose on me and stay in the property for free for 5 years. If you're in New York, you get the right attorney, it could be 10 years later, before the bank can actually get to the property.
It's just, I got to be honest, sometimes it drives me nuts when I speak to people. For instance, I spoke to our mutual friend, Brandon, right? He was calling me yesterday, and, he sold his business, the Airbnb business, and he's like, what kind of investments can we do together? This is my conversation with him yesterday, where I could get some yield. So I told him, I said, look, when we're lending on a deal, a lot of these real estate guys, and a lot of people don't know this, or some do that are in the real estate business, I said, the more active the real estate investor is, the less money he's got. It is what it is, right? It just has nothing to do with him. He's got the assets, but he's not liquid, right? So I said, you could come in on that 15%, and you could earn anywhere between 13, 14, 15, 16, up to 18, 19, 20% on your money, right? And he's like, well, what are the risks? I said, well, I have more risk. I'm taking fucking 85%, right, of the risk, because I'm lending out of $100,000 loan. I'm coming in with $85,000 fucking dollars that we're lending, and you're gonna have to come in for that 15%. He goes, well, why is it that I can earn so much more than you can? I said, you're going on the equity side, and it's just different. I'm in first position. So I explained this to him, and I said that the money's going to come back, and his reaction to me was, well, I'd rather be on your side. How can you just, I'm sitting on all this money. I'd rather take no risk and make less. And I'm thinking to myself, like, you're fucking out of your mind. I'd rather be sitting on your side. And if I'm putting up that 15% and I'm making 20% returns in 4 months, 5 months, 6 months, I mean, those are fucking 40%, 35, 40% on your money.
You do 2 to 3 of those and you got your money back.
That's
already.
what I'm saying. But to me, it's like people are so risk adverse, right? And and this is a guy, he's got money.
Yeah.
And it's not like, it's a guy, obviously, I'm not telling someone who's got $100,000 to their fucking name, right, to go in and put up that $100,000. Although I'm fucking psychotic, I would do it myself, right? I'm fucking out of my mind. But what I'm telling him to do is, he's sitting off, like, say, $5-6 million. Fucking take $1 million and do this. Like you said, you're gonna make that shit up. You'll make fucking $1 million back in a year, right?
I always look at people who are risk adverse is that they just don't understand the risk and how to mitigate it. Every investment you get into has risk,
right?
But how do you mitigate that risk? So being on the equity side in a joint venture structure, you can structure the deal where if they don't perform, you take ownership of that project, and you have your own builder or somebody that you can bring in, and then you get 100% of the upside on that. You cut the investor out that failed, that you financed. It's a simple way to get around that. So how do I protect, against principal losses? Well, where is that going to happen? If we we have a black swan event like the pandemic or something that occurs where market prices crash, everybody's screwed. Doesn't matter where your money's at in the stock market and real estate. You're gonna take a bath on that. Outside of sitting in cash, or treasuries. So I like to just isolate that type of risk because it's risk that's going to affect all parts of the market. Okay, you got execution risk. Well, we're not going to go put your equity into a project without somebody who's proven they can do this. And 99% of the time, if we're going to invest equity in a deal, it's somebody that we've done a deal with before, so we already have a track record with that person. We know them. We're not just going and taking Joe off the street, who's a general contractor doing his first fix and flip and giving him 100% financing and hoping he does a good job. There's enough investors out there that are high quality, A credit, that just have more deals than they have money to work on, but they have the resources and and the team to go out and execute on it. Like, that's where you put your money.
So let's play devil's advocate. I told him everything you said. Mm-hmm. So he came back to me. He goes, "Well, he's not putting up $1. What's his risk?" So I said to him, his risk is, bottom line, his risk is he's going to lose this deal. He is putting up some money because he's the one that's going to have to cover the initial money for the for the rehab funds.
Well, that, and he's got to personally guarantee the loan.
And I said, and he's got to PG it.
Yeah.
So I agree with you. I just think two things bother me. It's I speak to the guys that aren't risk adverse, right? That have balls the size of the fucking Empire State Building, and their answer is, 18-20% doesn't fucking tickle my balls, right? But, and then I speak to the fucking guys that are risk adverse, mm-hmm. and their initial reaction, this shit is too fucking risky. I'm like, you guys are fucking, both sets are nuts. It's like, it's so difficult to find the ones that have a fucking brain to understand, on the other side, I'm speaking to my other friend, and I'm like, bro, Bobby, let's fucking roll. And he's like, well, my money is in stocks. I'm making 60-70% on my money. I'm like, yeah, also, 2 years ago, you were looking at me fucking crying because you had all your balls up.
Yeah. You could lose 60 to 70%
right, that's what I'm
overnight.
saying. Like this.
Yeah.
It's like, it's to find that investor that understands the game that we're playing. That's just difficult. It's so fucking frustrating to me when I get people like this. So let's talk about Brandon, for instance. Mm-hmm. He's saying, you know what? I want to come in. I want zero risk.
Okay. And
I want to be in first position. How would you structure a deal? And I'm talking to the guys out there, whoever's going to watch this. If these, whoever is listening to this part, some want to put their balls up and some want to be like Brandon, they don't. All right? How would you say to that guy, to a Brandon, hey, come in, I'm going to make sure you have the least amount of risk, where you can make and what is that return? What do you think is fair for a return for a Brandon in a situation like this?
Yeah, look, nothing comes without risk. Even lending in first lien position, there's still risk.
Yes.
We take risk lending that money out day in, day out. Being in second or in an equity position is even more riskier, but generates a higher return. So going back to my conversation earlier about financing loans, mm-hmm. the bank typically provides a line of credit that gives you a percentage of the first lien note. Right. So, for example, like a typical credit line from a bank is going to finance 80 to 90% of the note, and then the lender, like us in this case, would put in the 10 to 20%, which would be kind of an A-B structure.
Right.
They would be in the A, position. We're in the B. The bank, let's just say the note, for example, is 10%. The bank might get 8% on the 80%, that they put up. They're not getting the full 10% note rate. So we would make a 2% spread on the 80% plus 10% on the 20%. So we would get what's called a leverage return.
Right.
So our return in that case, if my math's right, it's about 18%.
Correct.
On that, our B piece there.
Right.
And then the equity guy comes in, and he's typically doing like either a preferred equity structure where they're getting 12 to 24%, or it's a profit share structure where you carry the risk. Your risk is, the margin on the deal, and if they can actually get the project done for the cost that they think to and sell it, at the price point that they're going to sell it. Those are generally returns in the 50 to 100% range, but carry a lot more risk because you're not getting a guaranteed rate there. Depending on your investment size, the AB note structure is hard to manage on a single loan basis. If you really want that, just go buy bonds against mortgages. That's effectively what it is. A securitization or securitization package is, pool of loans, and they sell them in different risk tranches. So you have your AAA, AA, single A, triple B, double B, single B, risk profiles. And each one of those tranches of the securitization is a different percentage of exposure to the overall pool of mortgages. And that's a way that like big financial institutions, so like your insurance companies and guys that have very low appetite for risk, they'll go buy the AAA portion of the bond, which is like 30 to 50%, of the 70, 80% note, or loan to value. So their effective like exposure is like 30 to 40% of the property value. They're never going to lose that. I mean, if they do, we're all, everybody's screwed. But they're going to get like 2-3% interest on their money because they're in the least risky position. So, and then your double A's, your single A's, they all kind of price out different. You get a higher return, the higher you go up on the risk, the risk ladder. That's one way to do it. It's passive investing. And you could be at a really low exposure point. But
I told him, I said, go buy fucking treasuries.
Yeah, and
that's what I would do. Fuck, I want no risk. If treasuries go bad, we're fucked anyway. You just burn your money.
Put it in a CD, at your bank or something.
Which is fucking craziness. Yeah. We're finished on this episode 5 of Game of Loans. You've been listening to the Game of Loans, where real estate battles are fought and won. Make sure to fortify your defenses by subscribing. Cash flow is coming, and we'll be back next time to help you claim your throne. The war of wealth continues.